Hello everyone. I'm happy to meet you in the second session in which we are going to discuss capital budgeting. One of the important decisions that a financial manager has to take. As we discussed in the earlier session, that investment decision is one of the decisions that a financial manager has to take, in which he will decide about the future investments. So that is what we are going to discuss today. In the second session. Okay, what is capital budgeting at first? It is deciding about, it is a long-term planning about your investment. That's all, simple as that. It is the long-term planning about the investment that you are having. Okay, about the financing. That's what it means, right? So as we discussed earlier, we are doing capital budgeting for two important reasons. First one is that you are going to identify the potential profitable investments. The second is that measurement of cutoff rate. This we already discussed in the previous session about cutoff rate, what is cutoff rate and all that. But then let me quickly go through it once again. So first point is that identifying potential investment. Let us assume that a manager has more than 5 projects. Let us assume that he has 10 projects in his hands. So he has to decide what all the projects can be accepted, what all the projects is viable enough, what all the projects are having less risk, and all that he has to analyze. Out of which we have to decide whether how many projects can be accepted and how many projects can be rejected. So it is about accepting and rejecting decisions. That is one thing. And if he has only 2 projects and those are mutually exclusive, which means if he accepts project A, then the B has to be rejected. If the B has to be accepted, then the A has to be rejected. So mutually accepted. He can accept only one at a time. So whatever may be the thing, even if he has more than 2 projects in his hand or he has 2 mutually exclusively projects, he has to decide only what to accept and what to reject. So he has to identify the potential investments. So we say potential, it means that the projects which would earn expected future cash flows. So that, which means in terms of profit, okay, which would earn acceptable amount of profit. That is the potential investment. So that's the first decision that we would make. And the second one is measurement of cutoff rate. So the cutoff rate, we already discussed the expected rate of return. Okay. So at what rate the company would earn profit? Whether at what rate it has to earn profit to avoid loss. It has to at least what is the minimum range, and at what particular rate the company would avoid suffering loss, and all that is cutoff rate. So that has to be decided. So for these two major reasons, capital budgeting is normally being done. And capital budgeting is analyzed in 2 different methods. One is discounted cash flow method, and the other one is non-discounted cash flow method. So when we say discounted method, so when I say what is discounted, it considers only one element. It considers the time value of money. So time value of money, it just means as simple as that the present money has more value than the future money. The rupee that I have in my hand now is value enough than the future money rupee that I'm going to have. It might seem little confusing, but it is very simple. For example, if I have 100 rupees in my hand now, so I would buy, let us assume that I would buy 10 ice creams. So I have 100 rupees in my hand, I'm buying 10 ice creams. In future, for example, after 5 years, or let us assume that after 5 years, I'm having the same 100 rupees. Will I be able to buy 10 ice creams? Definitely not. People would come up with an answer that the price of the ice creams might increase. But if you think about it in financial perspectives, the money that I'm having now is worth enough to buy 10 ice creams. Wherein the money that I'm going to have after 5 years is not worth enough to buy 10 ice creams. So in financial perspective, it means the money that I'm having now is worth enough, is having more value, so that it buys more number of ice creams, right? The money that I'm having in future, it does not have that much of value, so it is worth enough to only fetch few ice creams, less than 10. So we say that the money that I'm having today has more value than tomorrow's money. Today's money has more value than tomorrow's money. As simple as that. This is what we mean as time value of money, which is considered. The time value of money is always considered in discounted cash flows method. So discounted cash flow method is one of the important method is that called NPV, net present value. So now PV, which you always says present value, whenever we calculate present value, it means it is being discounted. Okay, so I'm going to, for example, what does that present value mean, sir? Okay, for example, if I am going to earn 10,000 rupees after 3 years, I'm going to invest something in a business. I'm going to get 10,000 rupees as a cash flow, which means as a return, right? So I'm going to get 10,000 rupees as a return after 3 years. So what would be the value of 10,000 rupees at present? Because we, as I said before, the present value has more value than the present money. So the future money will be converted into the present money, and it will be checked whether is it good enough or not. For example, let us we are having so many examples in the upcoming slides, so you can proceed further. So as I said before, discounted value, whenever we say PV, which means present value, it means that it has been discounted, which means the time value of money is considered. Okay, and the present value method, NPV method, computes the present value of all expected future cash flows using a minimum desired rate of return. What does it say, sir? Sir, I'm going to invest, let us assume that, okay, the original investment that I'm going to investment is that 5,827 rupees that I'm going to invest. So I'm going to invest 5,827 rupees. The usual, for example, it is the investment will be alive for 4 years. The useful life of the investment is 4 years. So each year it is going to give me 2,000 rupees as a return. Okay. So as a what a common layman would think is that 2,000 for 4 years. So it would come about 8,000 rupees. So I'm investing only literally like 5,800 rupees. So I'm going to get 8,000 rupees as a return. So it's a profitable one. So that is what a common layman would think of. Okay. So, but it is not the case. The minimum desired rate of return, that's what here we have given. The minimum desired rate of return is that what could be the expected rate of return. That's what, simple as that. If I invest this much of money, I expect at least 10% to come back. Okay, if I invest 100 rupees, at least I want 10 rupees as a return. So this is the minimum expected rate of return. Okay, the desired rate of return. So that is 10%. Okay, so originally I invest 5,800, then it is alive for 4 years. I mean, the investment is alive for 4 years, and it earns 2,000 rupees each year, right? So what would be, whether is it viable or not? Okay, so here whenever we consider the present value of money, so make sure that we would be considering, this is the formula. Formula is not given here, but it is CF, cash flows, the future cash flows, divided by 1 plus R the whole power n. Let us assume that it is n. It is future cash flows divided by 1 plus R the whole power n. The future cash flow, as we said, 2,000 rupees, right? So first year 2,000, second year 2,000, and third year 2,000, and fourth year it is 2,000. And net, it might be asked because it's simple formula that you can calculate. So sometimes the present value and future values questions will be appearing. Okay, so the 2,000 rupees divided by 1 plus R. The R just means rate of return, the expected rate of return, or the minimum desired rate of return. That is what normally is being given. That is the terminology on which it is normally quoted. Okay, 1 plus r is 10% in the sum. So 10%, which means it has to be given in the decimal. So 1 plus 0.10. 0.10 means 10 percentage, 10 divided by 100. So 0.10. So 1 plus 0.10, the whole power n. N just means, it means time. For the first year, the n would be 1. The second year, the n would be 2. And the third year, n would be 3. If you put in that 2000 rupees in this formula, in the first year, you would get 1818. In the second year, 1600. As I said before, the present value money has money has more value than the future money. So, for example, the first year it has 1800 rupees, but in the fourth year it has only 1300 here. When it is converted into the present value, the future money will always have lesser values. So when you calculate all these things, when you sum up all these values, for 4 years it is going to give you only 6000 rupees as a return, not 8000 rupees. So when we look at it in the very common parlance at the very first sight, we would think that we are going to get 8000 rupees for investing 5800 rupees. But it is not the case. We are going to get only 6300 rupees. So whether is it profitable or not? So yes, it is profitable, because when you reduce your initial investment out of it, for example, you have got 6340 rupees and you have invested only 5827. So basically your profit is 513. Okay, what is NPV, sir? Now if the NPV is in positive, here the net present value is profitable, is in positive. So if it is positive, you can proceed further. If it is negative, you have to reject it, because it is not giving you the desirable minimum rate of return. It is not giving you the desirable rate of return, which means it gives you lesser than the expected value of return. So it has to be rejected. So net present value, it just gives you how many years that you're going to get profit. Here, first year, second year, third year, and fourth year. So in all the years that you're going to get, and don't worry about these values, and these values are derived using this formula. If 1 rupee is your cash flow, if you divide 1 rupee using this formula, if you have 1 rupee as your cash flow using this formula, these are the values are arising. For 1 rupee in the very first year, it would be having 0.90 as the value. In the next year, the value will be coming down, and these are the values are calculated using these formulas for 1 rupee. But we have calculated it for 2000 rupees. When you multiply it with 2000, these are the values arising. So don't worry about these values, and these are values derived using this formula only. Normally, it is given in the table in textbooks. It is given in the table in the appendix, right? So what normally that I want to conclude is that NPV, if it is positive, accept the project. If it is negative, you have to reject it. Then if you have 10 projects, okay, let us assume that 5 projects are having positive values, positive NPVs, in which you can decide about which one is having more NPV. So then you can go ahead with like that, but negative cannot be accepted. So this is one way in which the projects are being accepted. And then when you earn, it is also annuity table. The value is derived from the annuity. Just now I told you that it would be given in the appendix of the textbooks. So the table value, here the value is taken from the table. Okay. So here, for example, the values of the cash flows are similar for 4 years. The similar cash flows are being earned in a project. So you can use even annuity projects. Annuity table. If you take 4 years and 10 percentage, the value is that 3.1699. If you multiply that with your original, annual income. Annually you are getting 2000 rupees as a return, as a cash flow. So if you multiply that 3.1699 with 2000, you'd be having the same amount, 6340. When you reduce that from your initial investment is that 5827. Again, you would be getting 513. The same thing is that. But if the cash flows are same throughout the year, you can use annuity table. If it is not same throughout the year, then you can go ahead with the formula that I said earlier. 1 divided is the cash flows divided by 1 plus r the whole power n, right? So these are the NPV. So NPV, it just means whether it can be accepted or rejected. Whether is it in positive or a negative. Okay, so this is NPV. Just now we said what is whether can be accepted or rejected. Now, if is it a positive or negative. So NPV is a method computes present value of all expected future cash flows. Just now we had seen, we have calculated the present values for all the future cash flows for first year, second year, third year, and fourth year. So it computes the present value of all the expected. It considers the present value of all the expected future cash flows using a minimum rate of return. So that's what we had seen, and the outcome of it is that you have to either accept or reject. Okay, the decision rule is that if it is in positive, you can accept. If it is negative, you have to reject anyhow. And the NPV model works under the basic two assumptions. So the first assumption is that world of certainty. It means that you're going to earn profit for certain, which means whatever the cash flows that we have decided well in advance we are going to get that in future. Okay, there is no uncertainty involved. Okay, uncertainty means there would be change in the cash flows. Okay, so the first assumption is that there is no change in the capital, in the cash flows that we are going to get in the future, which means there is no involvement of uncertainty into that thing. Okay, predicted cash flows will occur, definitely will occur. That's what the first assumption that we make. And second important assumption is that there is a perfect capital market, which means okay, we the loans we borrow or give is being given in the same interest rate. It's not quite which is not quite believable, but then it is the amount that we get and we give has the same loan amount. It has the same interest rate. That's what it means. Okay, based on which the expected rate of return is being calculated. So these are the two major assumptions. The first one is very important because it the normally business has uncertainty, but we have the assumption that there's no uncertainty in future, so we can go ahead with the NPV. So NPV is always good to go ahead with. The second important model is the decisional rule, as I said before. Okay, if it is positive, if the present values or the sum of present value is positive, as I said before, if the sum of present value is positive, the project is desirable. If it is negative, it is unattractive. So you have to decide whether we can accept it or reject it. Then the internal rate of return. The second important method. Internal rate of return determines the interest rate at which the NPV is equal to 0. Now my question is, if my NPV is equal to 0, what it means? My NPV is equal to 0. It means that the NPV is equal to the initial investment. Is that right? That that present value is equal to the sum of present value. It means, let me show you an example. If NPV is equal to 0, it means now I'm having NPV of 513. Right? Now I have the NPV of 513. If it is equal to 0 means the initial investment that I'm having, which means that 5,800, this is the initial investment, will be equivalent to the for future cash flows. Here the future cash flows is 6,300, but it would be equivalent, which means 5,827. So NPV will be equivalent to 0. It means that the future cash flow that I'm going to get will be equivalent to the initial investment, which means I am not suffering due to any loss. Okay, I'm not suffering. I would not be definitely suffering with any loss. So that is what it means. So at what rate the NPV is equal to 0, which means at what rate it is equivalent to the break-even point. At what rate where there is no profit, where there is no loss, we would have studied. Break-even point is a point where there is no loss, where there is no profit, which means where the cost is equal to the return. Similarly, here internal rate of return is that deciding the rate of return. Rate of return means percentage. We will be seeing that in percentage. At what rate? Here, rate, which means at what percentage of rate, I mean the expected rate of return. Okay, NPV is equal to 0, right? So the minimum, for example, if the IRR is more, okay, accept the project. If IRR is less than the minimum desired rate of return, then you have to reject the project. This is the decision tool. It's quite simple. For example, if 9%, if at 9% I'm earning NPV is equal to 0, then you can accept. Okay. If I'm having 9.3 as an expected rate of return, more than 9.3 as a desired rate of return, for example, my IRR is 9%. Okay. But my minimum rate of return is 8%. My minimum rate of return, my desired rate of return is 8%. So here automatically IRR is more than the minimum desired rate of return. So you can accept. If it falls less than that, you have to reject it. Okay. So here we would be in IRR at what rate it meets the NPV is equal to 0. That's what it decided. And sensitivity analysis. Okay, sensitivity analysis, we know that it is all about what if questions. What would happen if it falls down like this? Okay, simple example, the same example we are going to use. For example, what would happen if this, the unexpected cash flow, for example, the expected cash flow is 2,000 rupees here. If it comes down, if it falls down, what would happen? Okay, so what if it happens, what would happen? Okay, so we would analyze about the events with the consequences. If this event arises, what would be the consequences? That is what we mean as sensitivity analysis. Okay, sensitivity analysis shows the financial consequences that would occur if the actual cash inflows or outflows differ from those are expected. Okay, expected if it falls less than the expected, or if it falls if it goes more than the expected, what would happen? What would occur? That's what the sensitivity analysis means. Okay, it's all about what if questions. What would occur if it happens? Suppose a manager knows that the actual cash flows in the previous example could fall below the predicted level. 2,000. If the predicted level, the predicted amount is that 2,000 rupees. If it comes less than 2,000 rupees, what would happen? Okay, so we have to go through it. Sensitivity analysis. We are taking the annuity table value, as we said in the earlier example. We take annuity table value. Because why we take annuity value? Because the cash flows are even throughout the year. Okay, so this is the formula. Cash flows, annuity value multiplied by cash flow. We do not know the cash flow, assuming that it would fall down, right? So in the initial examples, we have taken 2,000 rupees. Now the manager has said that he is not very certain, right? NPV works under the assumption that it has. We are very certain about the future, but it has no certainty in sensitivity analysis. So we do not know the cash flow. So let us have it as X minus the initial investment is equal to 0, right? Now let us simplify it. When you simplify it, when you take that 3.169 to the other opposite section, it would turn out to be the division. Okay, so it has about 1838. What does it mean? Okay, the annual cash flow can only drop either to this level. If you want to get zero, it can be dropped. The cash flows can be dropped only this much lesser. If it goes more than 162, I'm sure that you would suffer a loss, which means your NPV won't be zero and it would turn out to be negative. Okay, that zero equal to zero, it means at what particular point my NPV will be equal to zero. What point? So that has been decided. So your expected rate of return can be dropped until 8.1 percentage, but not less than that. If it drops more less than 8.1, I'm sure that you would suffer a loss. Okay, so that is what it means. In terms of monetary value, it can drop until 162 rupees. If it drops less than, more than that, for example, if it drops 200 rupees, I'm sure that that particular year you're going to suffer loss. This is what sensitivity analysis means. It is an extended form of IRR. That's what I would literally say. Then other model of analyzing long-term decision is that, payback period. It is a non-discounted cash flow method. Payback period is very simple. At what year I'm going to get my initial investment back? For example, in the same criteria, okay, here assume that you have spent about 12,000 rupees. Okay, you have invested 10,000 rupees. Let us take like that. Okay, an estimated life is of that particular asset is 4 years. Okay, so annual investment is that. Okay, assume that 12,000 rupees is your initial investment. Okay, initial investment payback period is equal to initial investment divided by cash outlay, right? So spent for a commercial stuff, an estimated year of 4 years, right? So what would be, so 12,000 divided by 4,000 annual savings of cash flows, which means 4 years you're going to get 4,000 rupees as your cash outlay. Your cash outlay is 4,000 rupees. 4 years you're going to get 4,000, 4,000, 4,000, the same cash flows, the same even cash flows throughout the year. So 12,000 divided for 3 years. What does it mean, sir? So these three, what does it really mean? It just means you're going to get your initial investment at the end of third year. Simple as that. For even cash flows, it is very easy. But for uneven cash flows, here the example is not given, but I'm telling you. Okay, let us assume another example. Okay, for the first year, you're going to get 10,000. For the second year, you are going to get 7,000. Third year, 8,000. Fourth year, again 11,000. Okay, okay, these are the cash flows that you're going to get. Now the cash flows are not even, so uneven cash flows. At particular this particular arena, how can we draw about payback period? Okay, it is quite simple, right? So the initial investment is, let us assume that 20,000 rupees. So the formula is that y plus b divided by n. Very simple. It just means year, balance, next year. Okay, so the year, I would say what is the year, the balance and all, next and all that I will tell you. Let us make cumulative for it. You know what is cumulative? 10,000. For next year, it would be 17,000. For the next year, it is 25,000, and then 36,000. This is cumulative. Okay, the Y a year means at what year it touches the capital, initial capital. 20,000 rupees, it touches in the third year. So we should not take it. So the lesser year, where is that? I mean, lesser than the initial investment. Initial investment is 20,000 rupees. It crosses in between the second and third year. It touches somewhere. It touches. So we have to take the second one. Literally, little lesser, the nearly lesser year. I mean, the year in which the capital is nearly about to touch, which means 17K. So we would say year is 2. How much of balance it is still we have to get? Out of 20,000 rupees, we have got 17,000 rupees. So the balance is 3,000. I've got 17,000 in the second year itself. So the balance of investment that I have to get back is just 3,000 rupees. So balance. What is the cash flow in the next year? 8. Okay, what is the cash flow in the next year? Not the cumulative one. The real cash flow is that 8,000 rupees. 8K. If you simplify this thing, okay, it would come in the month. It has to be converted into month, right? Okay, so if you convert that 2 years plus whatever that month comes in, so at this particular point of time, you would get back your initial investment. So for an even investment, this would be the formula. Okay, for even cash flows, let me erase it all. Okay, so for even cash flows, you can simply put this example: PI initial investment divided by cash outlays. So if you have even cash flows, you can use this formula. If not, Y plus B divided by N. So this is anyhow you can take it just balance and the next year. I mean cash flows in the preceding year. So that is the uneven cash flows. Now payback, simply payback period is the period at which you would get back your initial investments. Next, accounting rate of return. Accounting rate of return, it just tells you, expresses a project return. It expresses the project return as the increase in the expected average annual operating income. For example, it is quite simple, accounting rate of return normally being done in 2 different formulas. Okay, increase in expected average annual operating income, which means the formula is given in here, which means the annual incremental cash flow from operations minus annual cash flows minus depreciation. That's all. No, not a big thing. Annual cash flows minus depreciation is what we call as increase in expected average annual operating income. Cash flows minus depreciation. Simple as that. Initial required investment. Normally, ARR is calculated in 2 different formulas. One formula is this. Okay, so average annual, increase in expected average annual operating income divided by initial investment. For in certain formulas, in certain companies are updating increase in expected average annual income divided by average investment. Average investment, nothing but average investment is the investment divided by 2. That's a simple thing, but normally these are the 2 formulas normally being updated, but the result will be the same. Result will be in the second formula, if it is 5%, in the first formula it will be 10%. Simple as that. There won't be any big differences in the result. Only if you use the first formula, it will, if it comes about 10%, in the second formula it will come about 5%. That's what the big that's what the only difference in the formula. Okay, now accounting rate of return, simple as that. If you assume the following: investment is the same amount, useful life is the same years, 4 years, estimated disposal value is 0. What is disposable value? The final value of an asset. Okay, to calculate depreciation you use this formula. If you want to calculate the annual depreciation, the cost price divided by minus the end value, which means the disposal value divided by average lifespan of the period. This is the formula that we have studied in the 11th standard. So annual depreciation, to calculate annual depreciation, the straight line method, written down method, and all that method, we have initially we have updated this formula only. Okay, so cost price minus the final value, I mean the disposal value, divided by average lifespan of the year, I mean lifespan of the asset. So here the initial investment is 5,200 or 5,800. So cost price minus disposable value is 0. So here it is given, divided by lifespan of the asset is 4 years. So if you calculate this, the annual depreciation is 1,456. Okay. Now if you formulate this in this particular formula, as I said before, cash flow minus depreciation is, cash flow minus depreciation will be given here. Cash flows minus depreciation divided by initial investment. So that's what given here. Okay, so cash flows minus initial investment divided by the initial requirement investment, I mean required investment. So 9.3 percentage. The ARR is 9.3 percentage for a particular project. It means, okay, let us assume that the other project has 9.6 percentage. One more project is having 10 percentage, and the other project is having 5 percentage. So the lesser ARR has to be rejected. Simple as that, right? But I'm sure that we have already calculated IRR, the minimum, the rate of return at which the NPV is equal to 0. That whenever that you get lesser than that, you can reject it. Okay. As I said before, some of the companies are following average investment as the divisional mechanism. Then it will be double. Here it is 9.3. When we say initial required investment, when we take the investment as it is, okay, we have taken 5,827 as it is, so we have got about 9.3. But when it is taken as an average investment, you'd get about 18.6, only the double the amount. There is no difference, and there is no big difference in it. Okay, so that is average rate of return. And post audit, it is quite simple as that. Post, which means after analyzing, after investment decision, periodically audit is being done, whether we are going in the right track or not. So because as I said before, NPV is taken into the consideration that there is no uncertainty in future, but in the reality, ground reality, business is all about uncertainties. Without risk, nothing can be done. Uncertainty is equal to risk. So post audit has to be taken, because all your assumption, not necessarily all your assumptions can be true, right? So assumptions can be taken into the consideration when we calculate values, but it not necessarily, it has to be true always. So post audit periodically has to be taken, and follow-up of evaluations also have to be taken in post audit. So these are the capital budgets. Okay. What is normally being done in post audit is the investment expenditure on time and within budget. Whether we have to check whether the investment expenditure are being done on time or within the project, and all that things we have to check. Okay, so comparing actual versus predicted cash flows. As I said before, before investing, we are taking these decisions. Post audit, after the audit, we will be having actual, because whatever the calculations that we made about the investments are about only the predicted values. Okay, so after the incidents, after the investment, we would have actual versus the predicted, so we can decide where we had gone wrong and all that things. So evaluation of your project is what we call as post audit. And thank you for sparing time to listen to this. And I'm sure that this would help you in understanding the concepts. As we said in the inaugural session itself, we can only brush through the concepts, but the time is very limited. If you want to crack net or SET, it takes a little bit amount of effort from your side. Go through the old question papers and find out these things. You'll be able to answer the questions, if possible. And we would even arrange we would give even more time for the future. I mean, for concepts like this, because these are the very important thing that you can brush up your concept and like attempt the mock test. Thank you once again. Thank you all.